Greetings. I am the moderator, Megan Trillette, and welcome to our webinar featuring Dr. Thomas Ho, Dr. Muhammad Hassan, and Professor Murad Chowdhury on proactive bank asset liability management, new approach, principles, and income risk. Our presenter, Dr. Thomas Ho, is the founder of Thomas Ho Company, a New York-based financial technology company. Consult to major financial institutions, including AIG from 1999 to 2005, he designed the global risk management system, ALM processes for the life companies, and risk monitoring for derivatives. When Tom founded Global Advanced Technology, GAT, in 1987, he developed cutting-edge technology for delivering innovative solutions to 250 global institutional clients. Out of the top 10 largest life insurance companies, then 9 of them were GAT clients. Dr. Muhammad Hassan is a distinguished leader in financial economics and quantitative finance with a proven track record of driving innovation in risk management and strategic planning for financial institutions. His unique blend of academic rigor and practical industry and experience makes him a thought leader in proactive balance sheet management and governance. His work in the cynical behavior of regulation, risk, and returns in bank mergers has been published in the Journal of Financial Economics Policy, contributing to the field's understanding of systemic risk and market conditions. He is widely cited for his work and others financial institutions' systemic risks throughout market risk, banks' efficiency, frontiers, enhancement, and total factor productivity, and shareholder value adjustments to merger announcements that are being extended towards trading strategies and market risk management. He collaborates with scholars on groundbreaking research at the University College of London and the Bank of England on the intersection of political connectedness, firm performance, and financial regulation. Our other presenter, Professor Murad Chowdhury, is a well-known banker and board non-executive director with experience working with a diverse range of bank operating models and business cultures. He is a former CEO of a UK bank and is a Prudential Regulation Authority and Financial Conduct Authority approved person. Murad is a fellow of the Global Association of Risk Principles as well as the Institute of Sales and Marketing. He has a good understanding of financial strategy, balance sheet risk management, bond portfolio management, project appraisal, treasury asset liability management, structure finance origination, liquidity risk management, capital management, and risk government oversight, and has managed large and complex banks' balance sheets from capital, liquidity, and P&L perspective. He was also the chair of ALCO at different banks from 2003 and 2014. In our webinar, we are going to try to figure out the challenges for lending, funding, and senior managers to answer the questions: am I achieving my target risk, net interest income? Am I taking appropriate risks? And am I flying blind? Next slide, please. Our presenters are the authors of these following books: The Principles of Banking, the Oxford Guide to Financial Modeling, and publications in the Journal of Financial Economic Policy. These books and articles will help provide the context of the subject matter of today's webinar. We will have the chat open for any questions or comments that you might have, and I will guide throughout the meeting. For any immediate questions, use the raise hand symbol, and I will direct the question to our presenters. Now I will pass this over to Dr. Thomas Ho, Dr. Muhammad Hassan, and Professor Murad Chowdhury.
Murad?
Yes, of course. Forgive me. It wouldn't unclick from the audio. Good afternoon, everybody. Megan, thank you very much for the introduction. Although there really isn't any need to say quite so much about me, but thank you nonetheless. Evening or good afternoon or good morning to all of you. Thank you for joining. First of all, my thank you also to Tom, to Dr. Ho. It's a privilege to work with him. It's a privilege to be involved with him in any way. So this being a part of this webinar is a fantastic privilege for me. So we're going to talk about, as you heard from the start, we're going to talk about income risk, managing income risk, the 3 questions that Megan just highlighted at the beginning. How can we preserve income? Are we flying blind? Do we understand anything we need to from a balance sheet management perspective? And the proactive word is very relevant. If we think about the history, the discipline of asset liability management as it's practiced in banks, so specifically banking institutions, it's a discipline that's a good 50 years old in the history of banking. if we think about that and how it's been practiced since it was first set up as a unit looking across the whole balance sheet in banks and from the 70s onwards, 1970s onwards, it has been reactive in nature, insofar as one has business lines, and this is any bank in the world. One has business lines that go out and lend money to customers, and there are business lines that in all kinds of product types, and there are business lines that take in deposits from customers, again in a number of different product types, and that generates a balance sheet. That creates a balance sheet which generates risk exposures, particularly for liquidity, funding, interest rate risk, and capital risk. And then the ALM function manages the resulting balance sheet. So in other words, it's a reactive process. Now that works fine in stable environments, but as we've seen, whether it's this century with 2008 or 2023, or indeed last century with the early 1980s and bank failures in that period of time, as we've seen, assuming there's going to be a long period of stability is not really a safe assumption to make. And because stress events of any kind impact bank balance sheets in a way that could be existentially tough for them and ultimately lead to failure for when it's very severe, following a reactive process doesn't results in a balance sheet that isn't optimized to manage liquidity and capital. Okay, so post 2008, we have a number of challenges that make it more worthwhile to pursue a more proactive approach to generate a balance sheet. Now, let's get into the topic of today, which is, as you saw at the start, income risk. Are we flying blind? Do we understand balance sheet risk? Let's take interest rate risk as an example. When we look at interest rate risk exposure, non-traded interest rate risk, as the regulators call it, interest rate risk in the banking book, which indeed is what it is. It's non-traded interest rate risk. Due to international regulatory guidance, Basel guidance, we are now obliged in most countries around the world to measure that risk with two different metrics: an earning sensitivity metric, which we'll call net interest income and its sensitivity, the delta, and a present value of the balance sheet sensitivity metric, which we'll call economic value of equity with the regulator's term, EVE, and its sensitivity, the delta. These two metrics actually move in different directions for most banks under one set of interest rate move circumstances. So there's a challenge in managing one's non-traded market risk when trying to optimize a balance sheet, because there are two different metrics. They're calculated in different ways. They're conceptually different, and they move in different directions for the same change in rates. So that's straight away a challenge for us as ALM managers, and it's a challenge for us when we're looking to optimize earnings over a stable or a volatile rates environment, whilst at the same time preserving present value, economic value of the balance sheet under the same set of circumstances. Okay, so that's straight away as a challenge for us. And this is a challenge for any bank in any country. It's not jurisdiction specific by no means. And it's not specific to the size or the systemic importance of the bank either. Okay, so next slide, please. So having identified one type of optimization challenge and indeed balance sheet management challenge, just one, the dynamics between delta or sensitivity in earnings risk and in present value risk, NII and EVE. Having identified that, and that's just one, we now want to. I want to introduce the third question in Tom's slide about, are we flying blind? Do we have the information we need? Do we have the information we need as ALCO, as an asset liability committee, and indeed as the board of directors? Do we have the balance sheet data in the form that is useful to us, that enables us to make decisions, that enables us to pursue a strategy of proactive asset liability management? In other words, not reactive. We try and optimize a balance sheet structure that suits our risk appetite, but also maximizes our income and also meets regulatory requirements. Do we have the information we need? So that slide there is simply to say, and it's just but one example. Child West Bank is a hypothetical bank. Okay, it doesn't exist unless anyone out there wants to, maybe invest, say, between $5 and $20 million to and ask me to set up a bank. But until that happens, Child West Bank is a hypothetical bank. That's an example of what I call the one pager. So what would you put on your dashboard, your one pager, that captured in a snapshot all the relevant information you needed so that the ALCO and the board could make the right decisions? That's a challenge I ask you as ALM managers. So just to reiterate, the challenge is, do we have the information we need that enables us to make decisions that optimizes the balance sheet? I already highlighted one challenge, the dynamic between earnings sensitivity, NII, and present value sensitivity, EVE. Do we have information we need to make all related? Sorry, forgive me. Just before we move on, back again. Sorry. Back to that slide. Yes. Do we have all the information we need? Now, there we've got an example of capital metrics, liquidity metrics, interest rate metrics. Okay. Actually, the interest rate metrics aren't even on there, so maybe they should be. Let's challenge what's on there. It's a challenge to produce data and report it in a way that enables ALCO to make the right decisions on managing the balance sheet. Okay. So I throw that up as a challenge to you. What is your ideal one pager for your ALCO MI pack and your board MI pack, so that the senior executives and the directors of the bank have all the information they need to make the right decision? Okay, next slide, please, Tom. Okay, here's an example of how one might report basis risk. Now, this is actually the UK regulators' interest rate risk return template. It's the reporting template standardized for all banks. And if you look here, it's showing you the mismatch for contractual tenor of fixed rate product and floating rate product. Okay, this is a reg reporting template. Now, I put this on here simply to ask you again, right, how do we want the information presented to us? If you look at that reporting template, it says basis risk summary. You've got all the notional balances of your loans and deposits put into cells relevant to their contractual maturity if they're fixed rate, and their floating rate interest rate repricing tenor if they're floating rate. And if you look at the pink column, you'd have the mismatch by time bucket, by tenor bucket. Is that sufficient information for us? That's why I've got the question at the bottom. What is this management information telling you? Is this sufficient information for us? Can we make decisions to optimize earnings risk sensitivity and present value sensitivity on that information? Personally, I think not. I think it's fine as a reg reporting template. The regulator sees this for every bank, but I think we need more information to enable us to make the right decision for earnings and present value sensitivity. Okay, so again, I've put that slide on as almost as a challenge for every bank. Do we have the right information, balance sheet relevant, balance sheet aggregate information that enables us to make decisions in this one example to optimize earnings sensitivity and present value sensitivity? That's really the question I'm asking. And you would have guessed my answer. That's not sufficient. We need to have great additional information to enable us to make the right decision. Okay, next slide, please. And I think that was my last one, Tom. So yes, sir, I will hand it back to you, Dr. Tom. And thank you for listening, everybody.
Thank you very much, Professor Chowdhury. And yeah, asked all the questions are very challenging. So what I will do is to introduce this income risk model, but I believe will answer some of the questions that you have. An income risk model, we have spent a number of years developing the models, as well as using our proprietary data to validate and verify the practicality of the model. And I have this pleasure today to describe what we have discovered and what we have found, and share with you some of the practical applications of it. The most important message I want to get across is that we should view risk drivers also as performance drivers. We often think of all the risk we are looking at, like Professor Chowdhury just talked about, is shocking interest rate up and down, impacting on EVE, economic value of equity, and net interest income, NII. But that's risk. But we should also understand that the underlying part is the performance drivers. So it's not in looking at risk per se, but the performance we should be focusing on. And I will therefore substantiate this statement with the following discussion. The following discussion is that NII and EVE are intricately related. I will show how they are interrelated. And then I will share, more important is that they share the multiple drivers together. So in other words, you cannot separate them in isolation, as Professor Chowdhury talked about. Should we be maximizing NII or should we be maximizing EVE if they go in opposite direction? But that is not the question we should be asking. The question we should be asking is how they are related and what are the true underlying drivers, the performance drivers that affect them. And I will talk about what are these drivers and how we can change the way we think of a proactive balance sheet management. Proactive balance sheet management is not proactive avoiding crisis. Proactive is about improving our performance. Therefore, we are talking about what drives the performance of the balance sheet that we should be looking at. And therefore, in this proactive balance sheet management, we'll be focusing on what are the underlying performance drivers. To illustrate my point, I will use Silicon Valley Bank as an example. Now, Silicon Valley Bank, there's a lot to talk about, and that's why I chose it. I'm using publicly available information, and it shows how this case study demonstrates the proposition I'm making. What you're looking at the chart is the NII, net interest income runoff, on the runoff basis, from Q4 2021 to Q4 2022, which is the last cycle before it collapsed. You can look at a chart. On the left-hand side of this chart here is the last cycle of 2021. You can see that the blue color is the product profitability. They have significant product profitability going forward for projected 5 years. And you can see dramatically this blue color getting smaller and smaller until Q3 of 2022 is kind of sliver of it. And finally, it even disappeared in the first quarter. There's no more profit margin left. But ironically, if you look at the numbers, the net interest income remained high. And also the EVE, economic value, also remained high. So the fact that the bank has no profit margin built into the product, as we know by now, they have a lot of investment portfolio. And I will come back to that. It close to 50% of the asset portfolio is in simple investment, MBS and treasuries. So in the rising rate scenario, those margins gone, but it's made up by other parts. That is the point I was trying to get to, is that there must be many other factors affecting our EVE EAR. By looking at them separately in silo, we're missing the story. And that is why you will see they go into opposite direction. And that really resolves the issue about this apparent paradox, if you wish, that we can manage the both measure EVE, NII coherently. And by doing that is by looking at the underlying performance drivers. Now let's drill down a little bit about the Silicon Valley Bank, what we call the performance attribution. Performance attribution says that if we look at each quarter, how the economic value change. So the red line explains how much it's changed. And then going forward, and this line, this the dot part, is the combination of all these other bars, all the contributors to the value. So this is an attribution. It literally shows you that what constitute the change in the EVE. But I want to highlight that 0 is here. That means the EVE, economic value, actually increases for 3 quarters until the last quarter by a significant amount. This is in terms of billions. So 3.8 billion, 1.7 billion increasing. Now, we also know that interest rate went up. Silicon Valley Bank reported significant unrealized loss. This is a turquoise color. The turquoise color actually shows that when rate went up, they did lose a lot of money. The last quarter, rate did not change. So that did not happen. And you also notice the yellow is the NII. It remained fairly stable. It is not like because of the crisis, there's no more net interest income. So the question is, we need to look at other factors that really affect the EVE. Other factors that actually show that EVE doesn't have to fall even though it's at the imminent of under a collapse, under a crisis. So now I will go further. If you look at the numbers, of Silicon Valley Bank in this period. This is the table of numbers that actually represented by the chart you saw earlier. And what I've shown here is the attribution. This column is the change in economic value. And the change is $3.8 billion, as I showed you earlier. This is the beginning of the period. This is the end of period. What's important about this report is that you can attribute this change precisely by where it came from. You saw earlier that the yellow bar is the net interest income, is here. But you have the refinancing part, because our number, the EVE number, actually come from the EVE regulatory report, and NII actually come from the EAR report. So the EAR report has a reinvestment required under static growth, whereas it's not a run-off basis. So therefore, there's a part in the 3 months how it's got reinvested. Is it making more money or less? This is what a lot of discussion about is the yield curve risk. You can see now it's significant loss. It's $1.5 billion, $1.6 billion, $2.5 billion. That is what a lot of discussion focusing on is the interest rate risk. What have not been discussed is the basis risk. Basis risk is crucial on a balance sheet because not every item on a balance sheet is only affected by the market rate. There's a spread risk. The spread can change. And when the spread changes, it creates the value on the EVE. Therefore, the basis risk should always be something that we should consider. And this is particularly true with some of the balance sheet that based on items with a much wider spread. And that creates the basis risk. Finally, is a transaction risk. Of course, there's transaction because we only have quarterly report. So therefore, during the 3 months, a lot of things happen to the balance sheet. You take the money out from the expenses, you buy and sell, roll over, and so on. So that's captured by a transaction risk. Then we can attribute every part. What is the takeaway? The takeaway, the crucial part, is that we now link the capital market economic value with accounting value. Very often people think that's accounting, different world, different paradigm. How can they be reconciled? Yes, they can be. Because at the end, they're both cash flows. It's really how you represent the cash flow. And they can be reconciled. So on one hand, you have NII, which is accounting. On this side is the EVE. Now they can be reconciled exactly how they should be realized. So in my introduction, I said it's very important not to look at NII, EVE in isolation, but in fact looking at the drivers of the performance, like yield curve risk, basis risk, and so on. And that was my starting point about some of the performance risk drivers are in fact the performance drivers.